Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. How are you, Bills? We're back again for another podcast.
We are back again, Andrew, and back in the recording studio.
Exactly right.
Favourite time of the week?
Exactly right.
That's it. Andrew, what are we talking to everybody about today?
Yeah, so today we're just doing a deeper dive into capital gains tax, what it is, depending on where your assets are held, how you calculate what capital gains tax is, and some of the rules around how you can reduce legally your capital gains tax, because no one wants to pay tax, obviously. So you want to try and minimize it as much as you can, but as long as you're minimizing it, not avoiding it, then that's it. You're on the right side of the fence.
On the right side of the line.
Yeah.
So you bend and push the line as much as you can.
Exactly.
So just for the sake of, I guess, the exercise, because capital gains tax is a mouthful.
Yep.
Let's just refer to it as CGT, so capital gains tax, because I'm going to get tongue twisted by the time we get to it. So I guess really simplistically, Andrew, we'll start with capital gains tax, CGT. What is it?
Yep. So look, CGT essentially is you making a profit on the purchase and then subsequent sale of an asset. That's really what it is, and that difference between your purchase price and your sales price, that's the capital gain that you're making, and that will go on top of your taxable income, and you will pay capital gains tax on that.
Just let me unpack that a little bit, because there was a few things in there. So we're talking CGT. The first part of what you described is the capital gain.
Yeah, just the CG.
Just the CG. So let's
use that to calculate.
Let's use an example. You buy an asset, and we'll talk about the different asset classes and things like that. But you buy an asset for $100,000. All else being equal, you sell it for $200,000.
Yep.
Your capital gain is the difference between your purchase price and your selling price. So $100,000 as your CG, your capital gain. The tax part we might get into a little bit later, because the $100,000 gain in this example is not the tax that you pay.
Correct.
It's the capital gain.
Correct.
Okay.
And I think that's a really common misconception for people, is not understanding the difference between the capital gain and the capital gains tax. And depending on where it's held, how long you hold the asset for, and some other rules associated with it as well, will help determine how much you pay in the tax element. But yeah, absolutely right. In first step and first thing that you want to look at is what's the actual capital gain.
Yep. And just before we jump into that, because that's what we'll talk about, we'll go into the cost base and things like that in a sec, but it's on an asset.
Correct.
It's not just on investment properties.
Yeah.
We'll talk about some exemptions with the family home and things like that later, but you can make essentially a capital gain on any type of asset.
Yeah, exactly right. So most people will think of property. I mean,
Yep.
First thing that people think of is a property, and that you're making a capital gain when you purchase and then sell a property. But really, you can make it on a stock. You can make it on a managed fund. You can make it on any investment. Will have an element of, hopefully, capital gain or capital loss. That's another thing that can also come into this equation as well.
Yeah, and we might talk about that a little bit later as well. But determining what the cost base is, so just sort of even going back in terms of what's a cost base, what is it, and how does it play into, I guess, the capital gain calculation?
Yep. So cost base is essentially the cost of how much that asset, the cost of how much was required to acquire that asset.
Yep.
So really, I mean, you think about the first thing that you're looking at, and let's use property as an example, because that's kind of the biggest one that's going to have a few things built within it. But when you purchase an investment property, you might purchase a property for $500,000. That's not your cost base. $500,000 is your purchase price. It's probably the largest contributing factor to the cost base.
Yep.
But in addition to that, you may have paid stamp duty. You may have paid mortgage insurance. in order to sell that asset, you might have paid agent fees.
Yep.
You might have, done some capital works on the property to improve it. All of that is all going to go into your cost base. So if you're wanting to reduce the capital gain that you're making, increasing and inflating the cost base is obviously going to go towards doing that. Now, whether you should or shouldn't, and whether that's, a worthwhile thing doing is a completely separate, discussion.
Yep.
But your cost base is basically all of the costs that were required to acquire that
Yep.
asset. And then also to sell and liquidate that asset as well. That's also going to add on to your cost base of that asset.
So in that example, we might throw some numbers around.
Yep.
Say you purchase your investment property for $500,000 and you sell it eventually for $1 million.
Yep.
Let's assume that your cost base, just to make the numbers nice and round, cost you $100,000.
Yep. So that's stamp duty, capital works, agent fees,
you
yep.
name it. So rather than purchasing it for $500,000 and selling it for $1 million, a $500,000 capital gain, it's actually $600,000 to $1 million.
Yep.
Because the cost base of $100,000 gets added to your purchase price. So it's not a $500,000 or $500,000 capital gain. In this instance, in this hypothetical, it's a $400,000 capital gain.
Yep. Exactly right. So I guess the question, Bills, is, all right, you've got a $400,000 capital gain in that exact same scenario. How do you work out the tax? What's the tax that you actually pay on that $400,000 capital gain?
See how Andrew threw that highly technical question over my way, so he set me up perfectly on that one. But look, I guess the first thing that we look at, and it gets more from a planning perspective, there's more options open depending on the ownership of the asset.
Yep.
So there's probably a handful of contributing factors. Firstly, and we might just use an example here again, where you've made a $500,000 capital gain.
Yep.
Okay. If you've owned the asset in question for longer than 12 months, assuming that you own it individually, the capital gain, you get an exemption for a 12-month active asset. So what that means is, in this instance, if you've owned, let's say it's an investment property and you've made a $500,000 capital gain, but you've owned that asset for longer than 12 months, that $500,000 capital gain actually goes to $250,000.
Yeah.
So that's the first thing in terms of how long you've owned the particular asset for.
Yeah.
So you've got a $250,000 capital gain in this example. If you own it in your individual name, essentially in the year that you incur that capital gain, that $250,000 in this hypothetical example will essentially get added to your assessable income. So whatever your assessable income is, add the $250,000 on top, and then you work your way through the tax brackets to figure out how much tax that you pay in that particular example. Where it gets really interesting, and from a tax minimization perspective, let's just say this was an asset that you and I owned combined, and we owned it 50-50, the capital gain would go from $500,000 to $250,000, being the 12-month active asset discount, and then half of that capital gain would get added to your assessable income, being $125,000, and $125,000 would get added to mine. Yep. So depending on what we're earning at that particular point in the year, then the gain can get, or the tax component can get massaged in that instance. A really good example of this would be if you've got a particular asset and let's say you retire in a particular financial year, maybe you sell your investment in the next financial year when you have zero income or minimal income because you're going to incur a large capital gain. So that will help pay less tax in that particular year.
Yep. And look, that's one example of probably 10 or 15 that you can utilize it to your advantage. But yeah, a couple of things that Billy's touched on in that scenario. The first thing is whatever your capital gain is, that's going to get added on top of your assessable income. So you make a capital gain of $250,000 or $125,000 in Billy's scenario, and you're earning you're just a normal PAYG salaried employee that's earning $100,000 a year. Well, if you've made a $250,000 capital gain, then you're going to get taxed from the ATO as though you earned $350,000 in that financial year.
Yep.
So that's the first thing. Second thing is, if you hold the asset for longer than 12 months, you get a 50% reduction in your capital gain. So if you sell an asset, the example that we used of 250,000 split between both of us, or $500,000 capital gain, if we sold that and it was joint ownership, if we sold that within 12 months, we would pay the full 500,000, a portion between both of us, 250,000 on top of our assessable income. You hold the asset for longer than 12 months, and all of a sudden, that same capital gain, even though you're still making the same amount of money, you're only paying, but the only amount that's going on top of your assessable income is $125,000 each, because you're getting that 50% active assets test, or active asset rule as well.
So essentially, after 12 months, 50% of the capital gain is a non-issue from a taxation perspective.
Yeah. And some of the strategies that we've used, or that we've seen in terms of trying to utilize either that rule or a combination of a couple of rules, is number one, you have an investment property, your intention's to sell it, and you're taking a year off work, or you're taking some time off work in a particular year, so your income's going to be lower. Or one partner in a couple, or maybe both people decide to go on maternity leave for 12 months and your income's going to be substantially lower. So you're timing your capital gain in the years where you have the lowest income, in order to be able to limit the amount that you're going to pay on tax as a result of that as well.
And that gets really powerful too, especially when you're in, I guess, retirement and you've got access to pension income from your superannuation. We'll talk about that in a sec. But just let's clarify the assets that capital gains gets applied to. And probably the biggest one in my mind to clear up is you don't pay capital gain tax on your owner-occupier property, regardless of the gain that you've made.
Yeah.
So that is exempt as it currently stands in Australia. That is exempt from taxation law as it stands.
Yeah. So the really big thing with that, or a couple of things with that, and you need to absolutely receive tax advice when you're looking at going down this route. But first things first, your owner-occupied property, the property that you're living in, exempt from capital gains, assuming that it's been an owner-occupied property from day one and until the time that you sell it. So you're not paying any capital gains from the property that you're living in. There is a 6-year rule whereby you purchase an owner-occupied property, you're living in the property, and then it becomes an investment property for a period of time. Now, maximum 6 years, can be less than that, but maximum is 6 years. You've got 6 years of not having another owner-occupied property. So you can't move from owner-occupied property to owner-occupied property to owner-occupied property. So you can't own another property that you're also claiming as an owner-occupied property. But you've got 6 years to move back in, and the entire period is exempt from capital gains tax.
That was a lot of owner-occupier in one sentence. So essentially in that instance, this, I guess, strategy you'd call it, it wouldn't necessarily be a strategy that you pursue, I don't think.
It was originally designed for expats, people traveling, work overseas. And I think that's kind of, explaining it in that way makes it the easiest way to understand. Yeah. Let's say, Billy and I are a couple, we own our property and we decide to go work overseas for 3 years. We've got, we own our property, we rent it out for the 3-year period that we're overseas. So we haven't got another property that we're claiming as an owner-occupier because we're, renting overseas. We then come back to Australia, move back into our property, and the entire portion or the entire period of time is exempt from capital gains tax. That was what it was designed for, so that people weren't being penalised for, going overseas, working in their owner-occupied property being an investment for a short period of time.
Yeah. And I guess if you're renting out your property in that instance, the income is still subject to income tax. So Correct. That's different to what we're talking about. I'm just starting to think about where we'd move overseas if we went, right?
Yeah. So, got to get our wives on board for that too.
Although the weather's pretty good in Melbourne at the moment, so no need to move just yet. Andrew, let's talk about, I alluded to it before, but if you're in pension phase or even before that, owning assets inside super, actually even one step before that, any asset. So if you make a gain on pretty much any asset, you'll be subject to capital gains tax, except for your family home. And probably if it's a small gain on a personal item,
you're not paying capital gains tax.
You buy a watch for $2,000, you sell it for $2,500.
Unless you're running it as a business, then different story.
Unless you're running it as a business, and that even goes to like vehicles as well too.
Yeah.
If you're running it as a business, completely different story because you're doing it for profit.
And there's a requirement on how many times that you can make a capital gain before you need to start paying capital gains tax.
So it applies to any asset. So let's talk about superannuation.
Yep.
And there's probably two distinct areas in super that we'll talk about, being in accumulation phase where the 15% tax environment is applicable.
Yep.
And then we'll talk about being in pension phase where the tax applicable is 0%. And understanding those two and working the sale date of your assets to match your circumstances can get really powerful, and hopefully we can do it justice with some examples and some numbers that sit around it. But if you've got an asset sitting inside accumulation phase in superannuation, and you sell it, and we're assuming that you sell it after 12 months' time, the tax rate in accumulation phase is 15%.
Yep.
If you sell an asset with inside, say you've got some shares and you sell them and you've made a gain on it, the applicable capital gains tax rate that you will pay drops down to 10%.
Yeah. So similar to the active assets test outside of superannuation, there's also the same rule inside of superannuation. There is one difference, however, in that you get a 50% reduction in capital gains tax when you own an asset personally, whereas in the superannuation, it's one third discount on the capital gain. So personally, you're going from your marginal tax rate 50% or a 50% reduction in the gain. Inside superannuation, you're effectively going from a 15% tax to a 10% tax.
Yep.
So no difference in the calculation, no difference in the methodology. The only difference is in that it's a 1/3 discount as opposed to a 50% discount.
Yeah. So almost in my mind, it's almost the best tax environment to be able to incur a capital gains tax.
Yeah.
Except if you're in pension phase. So this is where it really gets powerful. Andrew, take us through it.
Well, it's a pretty easy scenario to talk through when you're talking about capital gains tax in pension phase. But if you've managed to, accumulate your assets, have them in pension phase, you're under the transfer balance cap. So, all of those requirements being met, the capital gains tax is a big fat zero.
Hang on. Say that again, because I think we really need to emphasize that.
0% capital gains tax when you're holding or when you're incurring a capital gain in pension phase.
We'll just have
just the
intentional silence. If we could, I'd be doing the mic drop. But okay, wow. So once again, we talk about the power of superannuation, which is really a tax-effective retirement savings vehicle. But with some proper planning, you can get to a stage where if you own assets inside your superannuation and you convert across from accumulation phase to pension phase, when you either stop working or you hit age 65,
you're paying no capital gains.
You're paying no capital gains tax on that.
Yeah. Yep, exactly right. And let's kind of and the way that I like to look at it is, all right, let's put an example of actually how powerful this is. And let's say, all right, you purchase an asset for $500,000, whatever that asset is. Let's say you purchase a parcel of shares just to make it nice and easy.
Yep.
If you own those shares and if you plan ahead early enough. So let's say, someone who's in their 50s, you're buying $500,000 worth of shares in your 50s. You go down the simple traditional route of buy it in your own name, invest in your own name. That $500,000, you don't sell it until, or that parcel of shares, you don't sell it until you're 65 and retired. You buy it in your own name, you've made that $500,000 has now gone up to $1 million in terms of the value of the shares. You haven't added any additional money or anything like that. That's just the value of the shares. $500,000 goes on top of your assessable income. Now, let's say you've timed it perfectly and you've sold the assets after you've finished working. So fantastic, your income tax doesn't form part of this calculation. that $500,000 becomes your assessable income. And Billy's actually pulling it up right now because
we need some numbers.
We need some solid numbers to use it. But $500,000 held it for longer than longer than 12 months. So it's a $250,000 capital gain, not a or you're paying tax on $250,000 worth of capital gain, not $500,000 capital gain. And the tax that you're going to pay on a $250,000 income is $92,000 worth of tax.
Versus if you held it in superannuation, if you sold it in accumulation phase, you'd pay 10%.
Yep.
Which is 10% of 250 is 25,000.
10% of 500.
But we had the active asset discount.
1/3 active asset discount. So you've already discounted it on the 10%, on the 15%.
Yep,
so it's down to a 10% tax rate.
Yep.
So 500,000 times by 10%, 50,000.
50,000.
Which is a good saving. Like you're still talking about a solid 42 grand from just holding it in a different environment.
So 92,000 tax in your own name, 50,000 tax in accumulation phase, and 0%. It's not even percent, zero tax in pension phase.
Sell it in pension phase.
Yep.
So you're talking about almost $100,000 difference by purely holding your asset in not the right, because it's not right for each and every single person, but if you've got the disposable money, if you know when you're going to sell it, you can utilize these rules to pay zero capital gains tax in that environment.
Yeah.
So it's massive.
It's absolutely huge.
I mean, you consider how long it would take to acquire, $100,000 worth of growth in any asset. Because you're not talking about contributing 100,000, you're talking about just the growth to outstrip that. It would take a significant amount of time and some really good years to be able to make that off a $500,000 investment versus instantaneously using the tax rules. So it's something that's a known as opposed to an unknown with an investment. It can really ramp up your strategy provided that you're planning for it and accounting for it throughout the course of your working life.
I'm that excited by it, Andrew. I think I'm going to go and find some more money to put into my superannuation, right? So eventually when I sell assets, it's 0% tax.
Yeah, well, you're, a couple of years away from being in pension phase. So
I look very good for a, 63-year-old, you reckon? So, yeah, well, I mean, that's the power of, I guess, knowing the tax system and combining that with the superannuation system, and I guess trying to highlight and beat our own drum a little bit, but trying to highlight the power of some forward planning and engaging with a professional financial advisor. Those numbers are huge, and that was on a $500,000 investment that we were talking about. What if you had a commercial property that was sitting in there and it was worth more, and the numbers just keep getting better and better. So yeah,
exactly right. So I guess the other thing that's really important to kind of note and discuss as we're sort of wrapping this topic up is make sure that in all of this, you're receiving financial advice around structuring things, but you're also talking to your accountants, your tax agents, and making sure that whatever you're doing is in your best interest and actually right for your personal situation as well. That's a very important note.
Yep. And on that note, Andrew, thank you. I reckon that was full of value, and I'm quite excited about minimising capital gains tax and the strategies,
minimising any tax, really,
and the strategies that are available with that. But no, thank you, and to our viewers and our listeners, thank you for your time and attention. If you want any more information or you want to discuss anything about your own personal circumstances, please feel free to reach out. Details, like always, are in the show notes.
And if you like this video, make sure that you like and subscribe, and we look forward to catching you on the next podcast.
Thanks.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.